Today, folks, I wanted to provide you with some updates on my Canadian stock portfolio for that juicy passive income in this abysmal market we've been experiencing over the last month. And I want to break down the positioning, where my corporate account sits, where my tax advantaged account sits, what I want to buy moving forward, and just so much more in between. Is basically we've been primarily focused on paying off the mortgage this month. We actually put an extra $30,000 toward it. I think it knocked the total amortization period down by like 6 years, which was pretty wonderful. It's been a good focus for us, bringing the total mortgage down to $190,000, which is way more manageable. But as we get into the end of the year, obviously I had to pull money out to pay for this condo by taking it out of my tax advantaged accounts. And like a squirrel without his nut, I've been dying. I've been angst to start putting money back in there and getting back to a place of stability where I'm stopping moving all these accounts around. And like Warren Buffett says, the bar of soap, the more you play with it, the less you have. But let's get into this by taking a look at the broader view of the portfolio first and foremost, which if you like this overview and the way I track my portfolio, I do give this in my my patron members account. You can get access to all my spreadsheet tools. It's like $5 a month. You can talk to me in my chat group directly along with other 6- and 7-figure investors, and you can even reach out to me privately if you have any questions, concerns, or things you'd like to talk about on the investing front. But the portfolio today is worth around $154,000, completely wiping out all of the gains that I had pretty much this year, because I was up over $10,000. So we're basically back to null, which again, I don't really care for, because I just see this as an incredible opportunity to start buying some individual positions here. But we'll take a look at the simplified and refined portfolio as it sits in this moment from a place of stability. I do primarily just hold 3 ETFs, VDY, VOO, and SCHD. And as I've been mentioning, I've been looking at selling VDY because it's primarily held in my corporate account, where I am taxed at a 50% rate on my passive income, my dividends, unless I pay it out directly to myself, where again, it's put in a taxable position. But because I have two separate businesses, I have a salaried income position and I have my corporate income, I like keeping those completely separate because the corporate income is taxed way more efficiently. And I was paying myself out of the corporation to help make the deposit for this real estate. So I'm really looking forward to getting to next year and being completely done with this mess of moving capital around, where I can really start just topping up my TFSA, where I have about $168,000 of contribution room. And what I'm going to be looking to do is primarily build up about another $10,000, if I'm lucky, $5,000 to $10,000 in cash by the end of this year. And right now I've got about $24,000 in my cashable accounts. And if I can get this up to about $30,000, $35,000, I'm going to draw $15,000 to $20,000 out of here, which is going to immediately go into my TFSA. Now, this isn't the entire emergency fund. My fiance has an emergency fund. We have a split joint account where we drew that $30,000 out of, where we still have a sizable amount of cash just sitting in there as part of the emergency fund for the mortgage and property tax and HOA payments. So I don't mind pulling this down to about a $15,000 position level in the cash account, but that's what I'm looking to do in this current moment. So let's just kind of get into this and we'll break this down a little farther. You can see I added some of the more speculative positions because I talk about them a lot, but I never really share them. So just to show you these smaller positions, and this isn't taking into consideration my fiance's portfolio. I don't want to get into her side of the accounts as much as I want to focus on my own accounts moving forward just for these videos. As mentioned, she holds things like Meta, Apple. She holds some of these individual stocks. So I've decided it doesn't make a whole lot of sense to be buying the QQQ ETF because she's already upper weighting a lot of the tech companies we get out of the S&P 500. So that's why I'm looking to sell VDY out of the corporate account and focus on 1 or 2 tech positions like Google, like Tesla, which we'll talk about a little bit farther into this video. But if this is a conversation you appreciate, consider hitting that like button as always. I know we talk a lot about dividends here, where I'm collecting about $4,500 annually, but I'm not a dividend focused person, as I'm very young and I believe total return has a much bigger impact on my retirement moving forward. So I like getting the dividend income, but it isn't going to be the primary focus until obviously I start getting into the TFSA, where I'll be splitting my money 50-50 between the Canadian and US markets, because I like VDY, I like my Canadian exposure, and that naturally comes with dividends. But again, it's not the core focus of this portfolio. But taking a look here at my RRSP, the Registered Retirement Savings Plan, I'm not going to be putting any money in this account probably for the foreseeable future, at least for the next few years. The RRSP is an account where if you make money, you can take a percentage of that income earned and defer the taxes on it into the future by putting it in this tax sheltered account. The problem with this tax sheltered account is it doesn't give me the same perks or benefits of tax-free income in perpetuity for the rest of my life, because when I draw the money out of this account, it's going to be taxed. So I really want to just pay the tax on the income I make and just quickly and as fastly and efficiently start rebuilding back that TFSA, because I have, again, $168,000 contributable room, and it's going to take me a long time to start building that account back. So that's where my focus will be moving into January of next year, and then I'll just split some of my money up, between the emergency fund for the mortgage payments, and then just start dumping as much as humanly possible back into the TFSA. So for now, SCHD, I'm down about 1,600, 3% on the position, but I like it dripping. I picked up another several shares on the last dividend payout, which I should update my dividend income for the last couple months. But nonetheless, I'm just going to let that set it, forget it, and it's my simplest account, and it's my least played with account. But taking a look at the corporate side of things, this is where I hold my entire S&P 500 position along with VDY right now. And I probably next week sometime I'll start scaling VDY down and looking to transfer to the US half of the account, where I'll buy more S&P 500. I do like it at these levels. I'll probably start picking up some Google shares, and I am looking at Tesla, but I am waiting for the next earnings period just to see, because I don't think it's going to be the greatest of quarters. I'm speculating more or less on that, but we'll see how it pans out. So that's where my corporate account currently sits. I won't be touching these positions, and I'll probably be continuing to add to the S&P 500 in here as I continue to make money in my business, and next year probably start paying myself out less. I might do one more big payout at the beginning of next year, just to again get extra capital to top up the TFSA, which again will be taxable, so it won't be a lot, maybe like an extra 5 or 10,000, and then I'll probably be done paying myself out of this account for some time. But let's kind of pivot over into what the markets are doing themselves, because it has been an abysmal week. And again, this is where I get excited. Most people are getting a little bit miserable. They get excited when the market goes up. I get excited when the market goes down. We're seeing a lot of Canadian banks at 52-week lows. Royal Bank, Toronto Dominion being my favorite bank, as mentioned. It's probably one of the few outliers that isn't hitting a 52-week low this year. So very intriguing, considering Royal Bank's paying about a 4.55% yield, the highest we've seen this year. Bank of Nova Scotia is paying almost 7%, hitting a 52-week low. Enbridge at almost 8% here, touching its 52-week low. Canadian Imperial Bank, 6.68%. In fact, the only thing doing well in the Canadian markets are the oil sector, with Canadian Natural Resources hitting an all-time high. And as mentioned at this point, if you love these Canadian banks, if you love these Canadian stocks, which I love them, for the rest of my life I'll be owning these. So I like getting them through VDY or XEI, some of these monthly dividend paying ETFs. You get the best exposure to the best Canadian dividend stocks, and it's just so much easier than, saying, oh, this one's lower, let me buy this, or you kind of just get a little too ADHD about it. So that's always where I've kind of come down to that conclusion of those monthly paying ETFs. But on the US side of the border, of course, we got Apple here, which I'm very intrigued to see how this pans out in the next earnings, because it's had like 2 or 3 consecutive quarters of negative revenue growth. And their last iPhone was actually, in my opinion, a bit of a dud release. My buddy actually bought it, and he said it's overheating when he's charging it and using it. So if you have it plugged in a charger, you're talking to people on the phone, or you're using it, he said it actually overheated on him, which was kind of shocking to me, considering on top of that, the glass on the back breaks super easily. It's probably one of the worst iPhone releases I think Apple's ever done. Now, don't get me wrong, we own Apple. I'm very bullish on Apple long term. It's just very intriguing to see, how they came to those conclusions to make it the way they did without testing it to that extent. But I don't know. We'll see what the earnings look like. So we got Microsoft here as well, performing pretty well and comparable to Apple. I guess still only down about 12% from the recent highs. What's Apple down? Actually, maybe Apple's now they're trading actually favorably in line. Microsoft, I think, will do fine. Where I'm more intrigued by in this economic circumstances, things like Amazon and Shopify. The e-commerce space, as mentioned in my live stream, retail is dying immensely. In this higher interest rate environment, retailers selling traditional, goods through a store are getting absolutely devastated. Makes it very scary to own REITs, but you go to malls and you're seeing a lot of stores swap in and out. It's very hard for these companies to maintain their margins in this kind of market. So the e-commerce space is growing, dramatically, and it's proving that there's still a lot of room for conversion in this space. So Shopify and Amazon will be very intriguing to watch. These earnings come out between the mid-October to the end of October. I'm going to be looking at Google here. As mentioned, I think Google is going to be one of the more intriguing plays for me on an individual stock basis, because it's one of the things we just don't have an equal weight to, as my fiance's primarily got her money in Meta, big position in Meta. She's got Apple, she's got Microsoft, she's got a lot of these tech positions. So I want to upperweight the ones we don't have exposure to as much, like Google. And again, I think Google, as mentioned, a good play to the self-driving side of things. Google's obviously a leader when it comes to YouTube, and as using Google Ads, somebody that uses it a lot, Google Ads has become much more efficient. They're giving way more views per cost right now. They've implemented a system on the back end of YouTube to simplify it. I think they're going to start seeing some benefit from that as well. So Google's one I'm going to be keeping a real close eye on. And Meta, these two have actually been really good performers this year. Meta's only down 7% from the recent drop. And I mean, if you take a look at the year to date, Google's barely down at all. It's down like 5%. So these two have been the tech outliers in the recent sell-off, which is nice to see. And then again, Tesla's one that, I think it's just because of the nostalgia I had with this company back in the day. I don't want to let it go because it's one that I could just see myself holding for the next 10, 20, 30 years. And again, I'd rather see self-driving making money like almost it is for Google. Google's fully operable with their self-driving. It's not at the scale Tesla has the possibility to achieve, but the problem is Tesla's just getting margins eaten away, whereas Google's not. Google has a much more foundational business, whereas Tesla's business, though I believe the car business is foundational, it's just that it's losing margins, they're cutting costs, and unless something dramatic comes out on the last earnings or the next earnings where they come out with a cheaper car or something just comes out of the side blinder that we didn't see coming, I don't see the stock actually doing that well because of the cost cutting and the margins getting eaten away. And even Elon said that this isn't going to be a great quarter because they're investing into more factories and ramping up. So I'm hoping this suppresses the stock price a bit, and that's where I'll look to potentially be picking up some shares. But this is just my opinion on the updates surrounding my Canadian stock portfolio. And again, if you want to support the channel, go down to that Patreon group. The link's down in the description below. But outside of that, I'd love to know what you're doing with your portfolio as well in that comment section down there below as well. Cheers.